One of the less high profile choices in Nintendo's November financial announcements was the decision to change the basis on which their dividends are calculated to make them more attractive to potential investors looking for dividend payouts. A dividend is a payment made to shareholders from profit. The alternative would be retaining the income within the company, which Nintendo has also done, or even buying back its own shares, which Nintendo has done in recent years as well. Now, this normally corresponds to a drop in the stock price since the value of the company is now less the sum paid in dividends. For this reason, there's not necessarily an inherent difference in the attractiveness people might find in stocks which pay high dividends and low dividends. The higher dividend is better for income and may be more attractive to older investors who want income security in old age, while lower dividend stocks will have higher inherent value, although, of course, for the investor, the only way to unlock this is to sell, which might not always be beneficial for Nintendo. From the point of view of Nintendo, therefore, there are some benefits to paying high dividends as well. Firstly, a lot of stock is likely to be owned by people who already are at Nintendo, and so this is in effect a pay increase to their own most loyal people who have been remunerated in this way. Secondly, it's likely to encourage loyalty among stockholders and therefore project stability. Higher dividend stock is probably more likely to be held for longer periods. On the other hand, reinvesting signals an expectation of growth. After all, if you're reinvesting the money into the business, it's for a purpose, hopefully. Now, Nintendo is investing heavily, but it may also want to signal to investors to temper some of those expectations, at least for the medium term. The Switch, after all, did very well indeed, and Switch 2 is off to a great start, but that's not to say that everything's going to be hunky-dory from here on out, and it's certainly not to say that they can match the absolutely golden legacy of the Switch over the long term. High value stock is fine for a scrappy company trying to balloon in size, but Nintendo now needs to consolidate a bit, and so moving to having higher dividends projects a certain level of security. After all, entertainment is an inherently turbulent industry, and the chances are that Nintendo may have choppy times ahead. For all we know, some of these choppy times are already baked in to the next few years. For example, if Furukawa already knew that some of the system's major titles were still a good way from completion, he might think back bitterly to the stock value drop in mid 2018. Nintendo had just launched an E3 presentation where it was focused hugely on Super Smash Bros. Ultimate. They'd also announced Super Mario Party and a few other things, but there was not a significant number of new major announcements. Ironically, of course, Super Smash Bros. And Super Mario Party between them would go on to sell the better part of 60 million, but all that notwithstanding, the mood music for the Switch wasn't great at the time. People were worried that, like the Wii U before it, there would be long game droughts, especially since 2018's lineup had been mostly ports and titles like Kirby Star Allies and Mario Tennis Aces, which launched low on content and then were finished in DLC in the months ahead. Stock prices can be subject to these kinds of emotional responses and panics, and it's completely understandable that people looked at the 2018 lineup and got worried. They weren't even wrong necessarily, since it was not really until June 2019 with Super Mario Maker 2, Fire Emblem Three Houses, and Astral Chain, and so on that Nintendo started putting out original game after original game in consecutive months on a consistent basis. The problem with a sudden drop in stock is that it can feed into a negative narrative that becomes self-reinforcing, and since Nintendo likes to keep their cards close to their chest, and they like to protect their developers' ability to work at their own pace, this can be difficult to navigate. In 2018, they dealt with this by launching a September Direct, which was stuffed with new announcements, including two long-term major AAA game announcements, Luigi's Mansion 3 and Animal Crossing New Horizon. But while Luigi's Mansion 3 certainly still looked good, it was evident that the textures were far from where they would be in the game's finished form, while Animal Crossing was scheduled for 2019 but of course ultimately slipped into March of 2020. Were Nintendo bounced into revealing these games early because of the stock price panic? Well, maybe. I certainly think they felt more pressure than they might have otherwise done, and you could imagine a version of that September 2018 Direct which didn't show footage of Luigi and which didn't give a date for Animal Crossing but still made broadly similar announcements. Time pressure isn't necessarily problematic for all creators, but generally speaking, Nintendo's commitment is to quality, And they really went all out in this presentation to emphasize that they wanted to take the time to make sure that their new games satisfy their audience in a major way. And you can kind of see why, because there's a real high wire act with what they're looking to do in the Switch 2 generation. Look at their two biggest selling titles of the last few years. Mario Kart World built a vast interconnected open world, and a section of the fan base turned around and said, it's light on content. Tears of the Kingdom spent 6 years in development, but many felt aggrieved at the sparseness of the sky and the depths and the recycled nature of the world of Hyrule. I'm not saying these criticisms are wrong at all, and my point is simply that when expectations run this high, you can expect to set your watch by the inevitable backlash. Meeting, let alone exceeding expectations is extremely difficult and requires time, and because many of their top AAA titles, the 3D Marios and Animal Crossings of the world, are once in a generational affairs, their success or failure becomes hugely market sensitive, in a way that probably wasn't even the case in previous generations when Nintendo had multiple consoles at once or were able to produce multiple Mario games within a generation. Now, having a higher dividend stock won't insulate Nintendo completely from the video game audience performing cartwheels of horror and glee at every Nintendo announcement and silence, but it may smooth over the rough edges if people maintain faith that Nintendo will be able to continue to provide a strong dividend payout. But will they? After all, raising dividends is one thing, but having to cut them is another matter entirely, and having to pay out this money routinely actually could make Nintendo less resilient in future downturns. It's one thing for Satoru Iwata to cut his own salary during the Wii U era, but Nintendo cutting the salary of pensioners investing in their stock is unlikely to generate positive publicity in the Japanese financial press. However, we know that Nintendo have always held a lot of cash in reserve, and they explained why that would be. The unprecedented period of profitability since 2020 was always likely to be a short-term bubble, but they have, over their long history, always maintained financial resilience, and so maintaining a higher dividend is one way to signal to investors to stay the course. We should also note that although the proportion of profits allocated to dividends will be higher, the payout would still be broadly commensurate with the success of the business. The payment is linked to the higher of two possible values: the consolidated payout ratio, which is an agreed payment rate based on the net income of the company, so effectively a guaranteed minimum, or the consolidated operating profit, which is a portion of the final profits made. Ultimately, since both income and the final profits are subject to the success or failure of the company's output, the dividend commitment isn't quite such a hostage to fortune, even though it is a larger amount than they have been paying up until now. From what I can gather, these payouts take Nintendo from slightly on the low side to slightly on the higher side of the Japanese average, although Japanese dividend payouts do actually remain low by comparison to other international corporations. I would guess, though it is just a guess, that this is because of the high density of tech firms in Japan, which tend to be high growth investment stocks rather than dividend producers, but this is something that previous governments in Japan have tried to change. Notably, Japan's former Prime Minister Shinzo Abe, whose eponymous economic philosophy Abenomics is much admired by the new Japanese Prime Minister Sanae Takaichi, aimed to print money and stimulate growth to grow companies, but also encourage larger dividend payouts, making foreign investment in the Japanese stock market more likely, and also helping the significant and growing portion of Japanese society who were pensioners. The Japanese Exchange Group, who operate and focus on governance in Japan's financial markets, have also been pushing higher dividend payouts for some time. If Furukawa is reading the weather in Japan's government correctly, they are probably moving with the prevailing expectations from the Japanese political and economic community for what a company of Nintendo's size should be seen to be doing. I definitely think this change signals a gear shift for Nintendo all the same. The strong likelihood that Switch 2 will become a market fixture, and the basis for Nintendo of having another 5 or 10 years of success, is a moment to take a kind of victory lap, but also to aim to stabilize the ship to weather potential problems ahead. For more on Nintendo's financial situation, do check out the playlist on screen. Thank you for watching, big thanks to the channel's Patreon supporters, and I shall see you next time for another Nintendo Forecast.